Good morning, everybody, and thanks for coming along to our webinar this morning on tax and financial planning. We have a big audience today, so it's our last webinar before the end of the year. Just as a reminder, for those who are unfamiliar with our webinars, there is a Q&A tab within Zoom, so please do submit any questions as we go. I'll either answer those questions throughout the webinar or at the very end. This webinar is being recorded. You are not being recorded, but the webinar itself is being recorded so that we can put the presentation and the video onto our website afterwards. We will email you a short online feedback form afterwards just to see if you have any tips on how we can improve these webinars, or if there's any other areas that you'd like to have covered in future webinars. And none of this constitutes financial advice. And also, just because the theme is on tax, Compass Private Wealth do not provide tax advice. You're always best to go through your own tax advisor. We have a number of tax advisors also on this webinar, and they're aware that we don't give any tax advice directly, but we speak about tax in the context of financial planning, which is exactly what we're going to speak about in the webinar this morning. So, these are the 9 previous webinars we've had. They're all available on our website. If you go to the Insights section of our website, compassprivatewealth.ie, and we have all the various PDF, PowerPoint presentations, and also the recordings. So this was due to be November, but because of tax return deadlines and pension deadlines, we pushed it back a week until the first Thursday in December. So just a bit about Compass. A lot of people on this webinar are aware of who Compass are and what we do, but ultimately there's 4 separate business names and service lines within Compass. There's the private wealth side, which is the main focus of investment management and asset allocation. There's Compass Pensions. We advise on all different types of pension arrangements. There's the financial planning side, which is more consultancy based and it's more look at the big picture. And then we have a specific dedicated charities offering as well for charities who have assets to invest. So all 4 of those sit holistically within our business model. Okay, so into the contents of the webinar. So wealth management taxes. There's a lot of taxes. I tried to summarize them into a few bullet points. So the first is tax on income. There's 2 types of income. There's earned income, which is employment. And as you know, tax will be deducted through the PAYE system. I'm not using this webinar to go through the tables of the standard rate and the marginal rate and tax credits or anything like that. This is more to speak about how it's relevant for wealth management generally. So earned income, employment income, which operates through PAYE, so tax deducted source, and also passive income, which is all other forms of income where you don't have to earn the money or be in employment for. So rental income, dividend income, pension income, that type of thing. So they're both taxed at the marginal rate of tax. Obviously, couples have joint assessment and the standard rate cutoff goes up a bit. So when you invest money, there's tax on the investment growth and there's tax on gains. There's tax on passing assets in your lifetime. So if you were to gift anybody else money more than 3,000 per annum, there's a taxable event. It may be covered under the threshold, the Group A, Group B, or Group C threshold. But generally, there's a tax on lifetime gifts, and that's what gift tax is, 33%. There's a tax on death to the extent that the value of the assets are greater than what the thresholds are of the beneficiaries. That's capital tax, inheritance tax. That's also 33%. Gift tax, inheritance tax will always be the same rate. And then the other one is just tax on activity and transacting. So investing, the stamp duty and legal costs for if you're buying an investment property, obviously legal costs, and there's VAT on fees and different things like that. So that's a summary of all the different ways where tax can be impactful on wealth management. How do you reduce that? Well, that's the purpose of the webinar. Obviously, specific tax advice would be needed on certain circumstances, but generally speaking, one of the main advantages to a pension, or the main advantage, would be reducing the income tax on the way into a pension, which we'll talk about later. The self-employed and company directors do have more flexibility on reducing tax. And that's because if someone is a PAYE worker, it's very hard for them to say to their boss, can you pay me a bit less, 20 grand less through payroll and put that into my pension instead. That's called salary sacrifice, which isn't possible. Whereas company directors, proprietary directors, more than 20% shareholders, including the spouse of a 20% shareholder, have a lot more freedom in terms of how they time their remuneration, what they invest their capital in, and so generally self-employed and company directors have a lot more leeway than PAYE workers. Focusing on tax efficiency with holistic asset allocation decisions is very, very important. So certain vehicles like pensions are tax efficient, whereas investing personally isn't as tax efficient, obviously, as a pension, because you have to pay income tax and capital gains tax when you invest personally, whereas that doesn't exist within a pension. Also being clever about, if you have investment losses, to structure your portfolio so that those losses can shelter gains. Using unitized funds. So if you consider an umbrella, if you go into a unitized fund with lots of different investment strategies within that umbrella, then all the losses and gains offset against each other by default. So that's an advantage to unitized funds. CGT, you may not have that umbrella structure, but you can have different assets that are subject to CGT that offset against each other. Again, we'll speak about that shortly. And also minimizing the 33% intergenerational taxes. Looking at small gift exemptions, section 72, which I'll speak about in section 73, gift tax planning. Okay, so we have 5 different sections to get through, and we have a Q&A at the end. Again, please do put any questions to me as we go. So starting off with investing in tax, which is probably our main, investing would be our main bread and butter business here in Compass Private Wealth. So in Ireland, and don't blame me, blame revenue, there's 2 distinct taxes for investing, okay? There's capital gains tax and there's something else called exit tax. Now, most people would be familiar with buying a property. So you buy a property and you sell it, and the gain is subject to capital gains tax. And if you lose money on it, you crystallize a capital gains tax loss that can be carried forward. And any income is subject to your prevailing rate of income tax, which might be, marginal rate tax, which could be 52%. That would reduce to 48% once you reach 66. And if your income is below a certain threshold, it might all be 20%. So CGT, capital gains tax and sale and income tax, that's the same for individual shares, or exit tax on funds, which is 41% on gains and 41% on income. So 41% is greater than 33% CGT, but the 41% income is lower than dividends or rent, which might be 52%. And there's another type of tax if you invest in bad offshore funds, which we're not going to cover here, which are very rarely seen within portfolios, but obviously investment management firms need to be aware to not invest in bad offshore funds. We do see it sometimes. Okay, so what's subject to CGT? Individual companies, shares, REITs, listed on a stock exchange. Certain exchange traded funds, there's a bit of work going on with revenue on this at the moment, but certain ETFs will be subject to capital gains tax. And what's not subject to capital gains tax and therefore subject to 41% tax would be domestic life insurance company funds in Ireland, open-ended funds. All open-ended means is that the value of the fund is reconciled to the price of the fund on a daily basis or weekly basis, whatever it might be. So open-ended funds, which are basically the same as Irish life company funds, but just not domiciled here, either generally in the UK or Luxembourg. And then ETFs, which are domiciled in certain jurisdictions. So the majority of ETFs all ETFs in Europe would be 41% tax. And here's just a table setting out the difference. So the rate of tax, 33 versus 41. There's income tax difference, 41 versus potentially 52%. With exit tax funds, after 8 years, there's an automatic deemed encashment, which means that if you put in 100,000 and it's worth 200,000 after 8 years, you have to pay 41% tax on the growth. Whereas that doesn't exist for CGT. So that can be one big advantage of CGT. And other times it's less relevant if the investment time horizon is a bit less. And then offsetting losses. So you could have, if someone said to me, I'm looking to sell my investment property next year and it's going to realize a 200,000 euros gain, and I also have 500,000 to invest personally, will it make more sense for 500,000 to some or all of it to go into CGT liable securities, because it's a hedge that if you do lose a capital value, you can sell some of the shares to offset against the future latent gain on the property. So again, every case is different. So as I said earlier, an umbrella policy, it can be very tax efficient also. It is subject to the 41%, but it's very, very clean. And any tax advisors here will have seen this for their clients as well, in terms of the ongoing requirements and filing and all that is so much simpler, because you just have one umbrella policy and the only taxable event is money coming out of the umbrella policy. But within the umbrella policy, you can have a number of different strategies below that. And you can switch funds and all that type of thing at zero tax implications. And one of the disadvantages would be to have a number of separate umbrella policies in a portfolio sitting side by side with a number of CGT liable securities, because losses in the exit tax funds can't offset against the CGT. So just a few tips on this. So if you don't have CGT losses and you're not going to have a portfolio life, then the CGT portfolio is a bit less attractive. But if you do have big CGT losses and you pay the standard rate of income tax, then the CGT portfolio can be better. One caveat here is that from an investor's point of view, I don't like using the word hassle too much, because one of our jobs and the job of a tax advisor is to minimize hassle for a client. But a CGT portfolio is a lot more complex and creates a lot more work for the investor, because you have to return tax on an annual basis on your income. You need to know what the gross dividend was, what the withholding dividend was, what the net dividend was. All needs to go into your tax returns. If corporate actions like a rights issue or a takeover happen, there's different tax implications as you go. So generally, a CGT portfolio might seem tax efficient from the outside, but you have to weigh up the additional complexity of managing that versus the simplicity of having a unitized fund at a 41% rate. So I generally use the rule of about 500,000 upwards would be more subject to a CGT. I actually had that at about 300,000 up to last year, and recently, when you see the simplicity of how the umbrella structure works, we use 500,000, and even at that, you don't necessarily, you can even go higher again. And I would be just mindful of, if you are investing in a CGT investment portfolio, just be a bit careful with these online trading platforms, because they are cheap. I saw a recent note from one of them that basically is completely commission free for certain jurisdictions. But you need to be mindful that it's not in their service level agreement with you to give you a comprehensive annual tax pack that your tax advisor can interpret very easily. So they let you do the hard work, and a lot of these platforms are actually European or UK based, and they don't have tailored tax statements for Irish investors, nor will they ever have them, because it's not their responsibility. So for some people, we have a case recently where we have a couple of cases where somebody will come to us and say, oh, I have a 50 grand to Giro, Saxo Bank or whatever it is, investment account here. And then they have this big old pension scheme over here that they don't manage. And we said, well, why don't you rid yourself of this CGT portfolio through this online platform and use your pension to invest in individual stocks. And you can do that now even with the insurance companies, the likes of who we, Cantor Fitzgerald, you can trade stocks under the Aviva platform. You can do the same with Standard Life, use a company called Stock Trade. So that is a far more tax efficient structure for the individual because they don't have to pay capital gains tax or income tax within the pension. And all fees incurred are through their pension, which is kind of before tax. So by default, it's tax efficient, rather than messing around with their personal money and having to pay tax and all that type of thing on the income and gains. Just one thing with US domiciled assets. In the US, they actually have a federal estate tax. So if you die and the value of your US assets are more than $60,000, Uncle Sam will withhold 40% tax, federal estate tax. So if you have US shares or US domiciled assets and you die, you could lose 40% of the value above $60,000. There is some estate planning you can do, which obviously we talk to your solicitor about that or your tax advisor, but there are ways you can mitigate that, but it's just something to be very, very mindful of, especially those who've worked for US multinationals over the years. Just with fees by default, annual fees within a pension are more tax efficient, as I mentioned earlier. So if you're paying a fee, it's better coming out of your pension funds than your personal money, obviously. Within funds, if you invest in a unitized umbrella fund and you're paying 1 or 1.5% per annum, by default, that comes out of the fund, it comes from the units of the fund, so it's a more tax efficient way of remunerating the fund manager than you paying personal money. So they come from within the fund. And we don't see as much in commissions nowadays. If you buy a share and you pay 1% stamp duty, or say commission and sell it and pay 1%. And in fairness, most investment firms have moved away from that, but it's actually a very tax efficient way from the investor's point of view, or from an intermediary's point of view, because commissions are non-vatable. And if you're buying 100 grand worth of stock, you pay 1% commission, your base cost for CGT is 101. If you sell it at 150 and you pay 1% commission, your base cost of your market sales price is 148.5 or whatever it is. So it's just something that for more higher level bespoke portfolios, I wouldn't rule it out as a replacement of management fees. Okay, so tax compliance. So just at a high level, so certain taxes, we talked about the taxes at the very start, are deducted at source through the Irish system. So you don't see the tax, you don't have to physically pay it, just comes out automatically. The obvious one is PAYE, on employment income and ARF income and pension income. But also, if you put one into an umbrella exit tax fund with any Irish-based insurance company, their role is to deduct the 41% tax after 8 years. Whereas if you do it through an offshore fund, it's your role to pay the 41% tax. And stamp duty and transaction costs happen at source as well. So all other taxes must be paid or claimed on a self-assessed basis, okay? So if you have rental income or investment income through your portfolio dividends, you need to file that once a year through your tax advisor. Capital gains tax, 15th of December this year, like 2 weeks' time, is where you pay tax for the first 11 months of the year, and any gains in December is paid in January. It's on a self-assessed basis. And as I said earlier, 41% exit tax on offshore funds after 8 years also. And pension contribution tax rate. So if you contribute your pension retrospectively, you need to file that in your tax returns or give the details to your tax advisor, and they file it in your ROS returns. If you purchase offshore funds in an investment portfolio, so just be mindful if you're using these cheap online platforms, if you're buying ETFs and funds, you actually need to disclose that in your tax return every year. So not just the income, but the actual purchase of it, which is a complete headache. This is where you'd see it in the revenue online returns. So you have to self-assess for the exit tax as well. And in my experience, the investment firm, they don't see it as their responsibility. So it's up to you to make your tax advisor aware of it and file it on your own part. And as I said earlier, domestic insurance companies do it for you after 8 years. So these are just some issues we've identified, in terms of how the reporting can be skewed with investment firms. So this will all be in the slides I'll send out afterwards. So do come back to me with any specific questions on this page. So I suppose what I'd say in summary here is that having all of your non-pension investments in one umbrella fund is actually the simplest. May not necessarily be the absolute most tax efficient, but from a filing compliance point of view, it's very, very simple. But if you do have CGT losses and you're more than $500,000, you want more bespoke, you want to be able to read about Elon Musk and buy Tesla or whatever it might be, then a portfolio with a stockbroker is more suitable for you, or half and half. So it's always important, and one thing we do with our clients, that before any funds are invested, we're clear on what the tax implications are. So you don't go into it blind and then worry 12 months later, oh my God, I haven't filed this or that. So, a lot of people who seem to diversify by having a multi-manager approach, when we get under the bonnet, they're actually all buying the same thing. So you need to be conscious of that from a tax point of view as well. And I would always say, talk to your tax advisor about just doing it, or ourselves in tandem with your tax advisor, about doing an overall investment audit, depending on the value of your assets and how long you have your funds invested, at least every 8 years, just to make sure that you haven't missed out on an 8-year tax due for offshore funds. Okay, so reducing capital taxes. So I'm going to whiz through this section here. A Section 72 policy is a life insurance policy. Okay, so generally I wouldn't advise this for anybody until they probably get to late 40s or 50, and equally anybody above the age of 70, it may not be possible even to get them underwritten from a health point of view. So really between 50 and 70 is the ideal age for this. And all a life insurance, whole of life Section 72 policy is a couple or an individual can take it out and they say, we'll get $1 million worth of life cover. They have to do a medical, just like anybody here who's had life cover has to do a medical. And if they have a sum assured of $1 million, then that $1 million will get paid out on the death. If it's a couple, on the second death, if it's an individual, on his or her death. And that $1 million is then tax-free to the estate as long as it's used to pay inheritance tax. So if you do a calculation for someone, they say, okay, there's going to be $1 million worth of inheritance tax, conservatively based on today's values, assuming the latter dies in 15 years. Or you can put a Section 72 policy in place now to mitigate that. So it's highly, highly tax efficient. The caveat is that you do have to do a medical, and sometimes, I suppose statistically, the older people are, the more different ailments they may have picked up over the years, and insurance companies will just refuse cover in certain cases or load you for smokers and things like that. But if you're in decent health, age between 50 and 70, it's definitely something worth considering. Section 73 is the sister policy, but it covers gift tax in your lifetime. So this would be suitable for, to be honest, anybody of any age. The difference with Section 73 is that it's just like a normal savings fund. You just have the option to use it to mitigate 33% gift tax. So I won't go through this in too much detail here because it is quite complex. But when we send out the slides, and we've a bit of info on our website as well about it, it would be worth reading up on it. Essentially, it's a monthly savings policy that you have to contribute into for a full 8 years. And then after 8 years, you have the option to use it to minimize gift tax. So for example, if someone said, I definitely have 300,000 cash that I'm going to give child A in the future. He or she's a bit too young to get now, but in the next 5 or 10 years, I'll give them 300,000, and their Group A threshold is already maximized. Well, what you could do in that case is say, okay, well, if you're going to give it to them in 8 years' time, contribute to a fund over 8 years, maybe put in 10 grand a year. After 8 years, let's assume that's grown to 100 grand. And then after 8 years, you can gift them the 300 grand tax, the 300,000 gift. Also gift them the 100,000 from the Section 73 savings policy. They will have to pay 33% tax on the 300,000 euro gift, which is 100,000. But because you give them 100,000 from your Section 73 policy, it offsets against that tax. So it's a very tax efficient way. So they'll end up paying the 100,000 tax, but on the 400,000 gift. So it reduced the rate from 33 to 25%. And this page here just talks about the differences that while I say they're sister policies, they're similar, they're completely different in that the Section 72 is, you kind of have to commit to that for life. There's one of the insurers has a 15-year opt-out where you can get 70% of your premiums back after 15 years. But generally, Section 72 is a whole of life policy you need to commit to for life. Whereas Section 73 is just a normal investment policy. In fact, we set up Section 73 policies all the time. And we just tell our client, by the way, this will be endorsed as Section 73. You have the option to use it for gift tax purposes in 8 years' time. But if you don't, then it's still a fund that's invested in your name, and it actually makes sense phasing money into the market when valuations are loftiest where they might be at the moment. The small gift exemption, okay, so any individual can give someone else 3,000 per annum. Okay, and it doesn't eat into the thresholds. So a retired couple with 4 married children and 10 grandchildren can gift 108,000 per annum. So this is, so when you say 3,000, people think, well, that's very little, but actually 3,000, 6,000 if it's a couple, and in this case, they've got 18 people below them, 18 descendants, the 4 children, the 4 spouses, and the 10 grandchildren. So that's 18 by 6, which is 108,000 every single year. So conservatively, there's huge savings here for people who have a number of descendants below them. Children below 18 can't legally own money, but you can set up a bare trust for them. We use Standard Life have a bare trust policy that's already pre-written, saves the clients a load of costs and legal fees in writing a bare trust. That houses a contribution. When they turn 18, it legally becomes theirs. And it is possible to set up a portfolio of a number of different bare trust investment policies. And it's from a behavioral point of view, it's a better way of just handing them money or transferring money into a bank account in their name when it's actually invested on their behalf. There's a lot less chance that they'll want to redeem the money out. My favorite area, pensions. So just to run through this, we've had a separate webinar on pensions, but we've actually had 2 webinars this year, one on retirement planning and another on technical pensions, both of which are on our website. So there's more content in those webinars, but just briefly, you get tax relief going into a pension, the company does, the individual does. You get tax-free growth within a pension. So if your investments grow by 10% in a year, if that was you personally, you'd be left with about 5 or 6% after tax. Whereas if it grows by 10% in the pension, it's tax-free. So everything you can invest in within a pension, you can invest in personally. The only things you can't invest in within a pension is you can't invest in anything that's not at arm's length. So you couldn't buy and invest in property and rent it out to a family member, for example. Buying property within a pension has become pretty much impossible with recent regulations as well. So it's a bit of a disadvantage, I must say, but generally speaking, they're so much more tax efficient than investing personally. And the pension threshold is 2 million, but because of an offset, it's actually 2.15 million. Then when you come to retirement and you take money out of a pension, exiting it, you get 25% in lump sum, the first 200 of which is tax-free. And then the 75% remainder goes into an approved retirement fund. On your death, your approved retirement fund is an asset that forms part of your estate up to, I think Charlie McCreevy brought these in originally, but in the past, a pension just gave you an income for life, and there still are defined benefit pensions or annuities like that. But an ARF is a capital asset So we often encourage people not to draw down their ARF until 70, not to trigger your ARF, and then you have to take an income out every year. But more likely than not, there will be a capital value remaining, which passes on to the next generation. It goes to your spouse first, if you have a surviving spouse, and if not, it goes to children. Over the age of 21, it's a 30% tax rate. And in retirement, the rate of tax on income is actually a lot less than one would think, because if it's a couple, you're not subject to PRSI after age 66, which is a 4% savings. And usually if your employment income comes down, your tax credits will be assigned to the pensions company, and you get a lot more net income than you may think in retirement. So contributing to a pension, you can only contribute against earned income, so you can't contribute to a pension against investment income. Employees and directors can receive employer and employee contributions, whereas the unincorporated self-employed can only make employee contributions because there is no employer. And here are the age bracket limits. Most people will be familiar with this. This is just for personal contributions. And company contributions don't count towards these limits. Generally, proprietary directors have more flexibility in alternating salary and employer pension contributions. We carry out actuarial calculations all the time for our clients to see how much the company can contribute based on the person's age, the pension retirement age, and how far off the 2 million threshold that they are. So it results in great planning for company directors, because they might have surplus cash on the balance sheet, and we'd say, well, actually, here's your max funding calculation. You can actually put X amount directly into a company pension scheme. That's not a benefit in kind for you, and a full corporation tax deduction for the company. So generally, pension investments are far more tax efficient than personal investments. That's why if someone has two different equal sized pots, a pension pot and a personal pot of capital, and let's say they're each 1 million, and they say, well, I want to have 50% of my exposure in equities. Well, I would say, well, put 100% of your pension, which is half, into equities, and 100% of your personal into not equities. And it's just a simple way of, that's a very high level example, obviously, but one should take your investment risk first and foremost in your pension, as opposed to personally. Just keep the questions coming in, guys. There's two little bits here on miscellaneous tax. Then we'll have a few minutes for questions. Protection, okay, so life insurance and income protection. So personal income protection policy. So obviously income protection is very important if you're out of work for a prolonged period. You do get tax relief on the premiums. A lot of people aren't aware of that. So if you're paying $3,000 a year on income protection, and your marginal rate of tax, it's actually costing you $1,800 because you have 40% tax relief. We obviously quote the price before the tax relief. But then if you do claim, you get, you pay tax on the income, but obviously because your employment income will have ceased, you're still instead dependent on your income protection income, you wouldn't be paying as high a rate on the income protection than you would have on your salary. Executive income protection is when the company takes out income protection on behalf of employees, or if you're a company director, the company can take it out on your behalf, and the company pays a premium that is not a benefit in kind for the individual, and it's a full corporation tax deduction for the company. If you take out personal life insurance like mortgage protection, or just generally I want to take out life cover in case I die, there's no tax relief on the premiums, but equally the tax payout to your estate is tax-free. But obviously how it gets distributed from there has separate tax implications. But I suppose generally the rule of thumb is if you get tax relief going in, you pay tax on the way out, which would be the case for income protection. And anybody here who's an employee, the premiums your company pay to life cover within certain limits is not, you do have to do financial underwriting if you were to have too much life cover. What the premium the company pays on behalf of the proprietary director or the employee is also tax efficient. And we previously discussed Section 72 policies. EII investments. So EII are relevant sometimes. You can invest in an EII product. This is the old BES scheme and receive tax relief at 40%. It used to be 30 and 10, and now it's just 40% upfront. And what's unique about EII investing as opposed to pension contributions is that EII can be sheltered against all income and not just employment income. So often someone who's retired and they've got a lot of rental income or whatever coming in, they can make these investments against to shelter their rental income. Now, what I would say is that EII is exciting and it's good, but a lot of these companies, you know, if they were good for the money, they could just go to the bank and get a loan, no problem. So a lot of them are kind of startups or SMEs who are indigenous and trying to come up with a certain idea. So I believe the most appropriate way to invest in EII is to go into a fund with 10 or 12 different companies. And yeah, 2 or 3 may not perform well, but actually if the other ones would perform well, you get a return. So it's a 5-year holding period, generally minimum 4 years. And ultimately, if someone put 50,000 in, it's costing them 30,000. And frankly, the objective is to get maybe 50 or 55 back after 5 years. So it's cost you 30 and you're getting 50 or 55 back. Generally, especially when you go into a fund, you're not going to make 10 times your money because you're going in more as a low note investor as opposed to pure equity investor. Direct investment does come with EII to side with specific risks, so I would be more mindful of going into a fund as opposed to an individual company. So timing worked out okay, 38 minutes past as per my watch. That's very good. I have a question here on what the expectation is for future taxes depending on who's in government. It's a very good question. The first thing we always look at is the 2 million pension threshold, and that's been quite consistent for a number of years now. So in nominal terms, the 2 million has stayed the same, but actually in real inflation adjusted terms, the 2 million is actually lowered by default because the value of risk assets like property and like equities have risen over the last few years. So 2 million threshold now is a lot less than it was 2, 3, 4, 5 years ago. So I'd see it very difficult to see how any government would reduce the 2 million down. Where the 2 million comes from is the higher paid civil servants would be on, just say, 150,000 a year. And assuming they've been in the civil service for 40 years, they've got full pensionable service, they retire at 65, 66, and they get paid 2/3 of their final income. It depends, public service, civil service, but let's say they get paid 2/3 of their final income, which would be 100,000 a year for life. So 150,000, 2/3 that is 100,000 per year. And what they do is you capitalize that by multiplying by 20 to say, well, 2 million is equal to 100,000 a year. And that's kind of where the 2 million comes from. So if the government ever said, well, we're going to reduce the 2 million to 1.5, there'd be a lot of public and civil servants who'd be very disappointed with that, obviously. So I think by them not increasing it every year, last few years, by default, they're actually reducing it. There's a lot of talk then about wealth taxes and different rates of additional surcharges. The way I see it, the Irish tax system is actually extremely, it's actually extremely progressive as it is, because the more income you earn, and there is a 3% additional USC levy on income for self-employed above 100,000. So there's people earning over 100,000 per annum in Ireland paying 55% tax at the higher rate, which is a lot higher than, say, someone earning 25 or 30,000 who are paying actually less than 20% because of the employee tax credit and the standard rate cut up, that type of thing. So I think any more onerous taxes that could be brought in would actually be too much, and people will decide to relocate outside of Ireland. So I wouldn't be as concerned about wealth taxes coming in, because capital is portable and people can move, and we're within the EU. So I wouldn't be as concerned about that. I think wealth taxes or any change of government could target maybe some of the corporations and some of the REITs and property funds and different things, but I wouldn't be that concerned for individuals. Another question here on view on interest rates and markets. That's a good question. At the moment, we've seen a bit of volatility in stock markets in the last week in particular. Actually, last night or yesterday afternoon, the US was up about 1.5%, and then the Omicron variant was announced. They had a case in the States, and markets actually dropped 3% from 1.5% up down to 1.5% down. So I think we're, as of last Friday, 5 days ago, we saw a big sell-off, the biggest sell-off year to date in markets once this variant became aware. So I think we need to be mindful that we're entering a period of volatility in the next while. So we've enjoyed investment growth over the last 18 months with not that much volatility, but I think there's going to be more volatility. Where will markets go in the short term? There's so many variables out there, it's very difficult to know. I would be just very mindful of making sure that portfolios are diversified, that you don't have too much invested, you still maintain amounts in cash or on post or whatever it is as your security. So if someone has 5 years of income or whatever it might be sitting in an account, either in post or bank accounts, that enables you to take a longer term time horizon with your investments, and so that the short term volatility matters that bit less for you. So guys, thanks very much for attending this morning. This is our last webinar of 2021. We'll send the slides